Everybody, today we're going to talk about all things mortgage insurance. We're going to talk about what is it a scam, how to shop for it, and how to remove it. And then finally, just some questions to ask your provider about underwriting and whatnot. So without further ado, here we go. So what is mortgage insurance? Essentially, mortgage insurance is a transfer of risk of default from the lender to an independent company called the mortgage insurance company. When a lender lends you money, there's a risk that you're not going to pay that back. And there's only certain levels of acceptable risk that banks are allowed to take on. One of the reasons for that is they take money from you and me, they take that as in the form of deposits, and then they lend that out to other people. And they can't lend that out recklessly. They're certainly heavily regulated about how they can do that. And there's only certain levels of risk they can accept. And the less down payment you have on a property that is securing a note or a lien, the higher the risk of default. Because if you stop making your payments and they have to foreclose on that, if there's not a lot of equity in that property, there's not a lot of ways for them to recover their full loan balance. And so mortgage insurance was introduced to allow people to finance properties with lower down payment amounts. And that's been a huge boon to the housing market, to our economy, to all of our wealth profiles, because we can get into homes without having to save 20% down. So that's essentially what it is. It's just at heart, it's a transfer of risk. And of course, risk has a cost. That risk has a cost, and that's why the mortgage insurance companies are paid. And that kind of relates to the second question is it a scam? A lot of people, I think very, sort of cynically and slanderously refer to mortgage insurance as a scam. And of course I've got no skin in that game other than I want people to get into houses and I want to help them do that. But clearly it's not. These companies are taking on risk. They absorb losses when mortgages do default. And there's a premium associated with taking that risk. It's a risk reward, and they do that. So it's certainly not a scam. It's a valid business transaction between a borrower and a company that's willing to help that borrower get into a home with less down payment. So it's a very valid product in the market, very useful product in the marketplace. Now let's talk about factors that affect mortgage insurance pricing, because that's essentially what you're doing. There are various ways that you can pay for mortgage insurance. The most common way is through an addition to your monthly payment. And you won't pay that directly to a mortgage insurance company. You will pay that to the lender, but the lender's not reaping the reward for that. They're not earning the income on that. That's going to the mortgage insurance company. The most common way is monthly mortgage insurance, but you can also pay just a lump sum up front. They will charge you an extra fee. It's a lump sum, and you can pay that up front. There's also what's called lender paid. That's kind of a misnomer, lender paid mortgage insurance, because you're really paying for it, but you're paying for it in the form of a higher interest rate. You take a higher interest rate and you don't pay an upfront fee for that. You don't pay a monthly fee for that, but you are paying it in the form of a higher interest rate. So those are various ways that you can pay for mortgage insurance, but they all are impacted by various elements of your credit profile and the property type. And so what are those factors that affect pricing on mortgage insurance? One is your credit score. Your credit score has a big impact, and that's for obvious reasons. A mortgage insurance company is insuring against risk of loss, and the risk of loss is measured in part, in strong part, by your credit score. Your credit score is a distillation of your past history of your responsibility with taking on credit. The lower the score, the lower your demonstrated responsibility of making your mortgage payments or making your credit payment, your debt payments. And so the lower your score you have, typically the higher your cost of mortgage insurance is going to be. Loan to value also affects your mortgage insurance. If someone has 15% down and they stop making their mortgage payments, there's more equity there for the mortgage insurance company or the lender to recover. So there's less risk of loss for that insurance company or that lender than if you put 3% down. So if you put 3% down, you're going to pay more for mortgage insurance than if you put 15% down. The property type also has an impact on credit score. Is it a single family residence? Is it a condo? Is it a manufactured home? And you'll see a common theme here, and it's not hard to follow, is that all of these factors correlate to risk of default. And some people, that's not as intuitive, as of course your credit score correlates to risk of default, but property types do as well. Single family residences, condos, manufactured homes all carry with them different statistically demonstrated risks of default. And so depending on the type of property, single family is the lowest risk of default. So you're going to have typically a lower mortgage insurance factor than if it were a condo or a manufactured home. Your debt to income ratio can influence that. And of course, that's fairly intuitive as well. If you're If you're putting 15% down, but your debt-to-income ratio is quite low, then your risk of default is less than if you're putting 15% down and your debt-to-income ratio is quite high. You're committing a large portion of your available income to that mortgage payment. You have less cushion to absorb any sort of hiccups, any sort of shocks to the system. And then property use. Is it an owner-occupied property? Is it an investment property? Is it a second home? And again, these all correlate to risk of default. And these are very knowable, statistically derived factors. There's vast amounts of data that these companies have, that Fannie and Freddie have, that are historically based, that can tell you, okay, the risk of default for a owner-occupied property is much lower than an investment property. People are, and that is sort of intuitive. People are much more willing to walk away from an investment property than they are for their home that they're living in. So those are the things that affect it. Some of the things that I do want to illustrate, some of these factors, because they're the more pronounced factors and the ones that are more common. And that's down payment and the credit score. And you can see on this chart right now, what I've got here is differing credit scores. And like mortgage pricing, interest rate pricing, mortgage insurance pricing is generally denominated in 20-point increments. So if you have a 680 credit score, your mortgage insurance cost is probably going to be about the same as if you had a 699 credit score. But if you have a 700, your pricing will generally get better. And so what I did here was just took a basic transaction, and I'm sorry I don't have what this loan amount was. I think it was like $500,000 and 20% down, or $500,000 with these various down payments and these various credit scores. And what this is showing is what is the impact of different down payment percentages given the same credit score, and what is the impact of different credit scores given the down payment percentage, same down payment percentage. So for example, if you have, let's say, a relatively lower score of 680 and you have 15% down, your mortgage insurance component is $78 a month. Now, first of all, I just want to take a step back and appreciate that. Think about your overall mortgage cost and how relatively small a component that is. And this is someone with not great credit. But if you have 15% down, your mortgage insurance component with even just sort of fair to middling credit is really quite low. $78 a month and a whole payment of, what's it going to be, $2,500 a month or so. So really quite modest, and really shouldn't be a major barrier to considering purchasing. Of course, there's lots of things that go into that decision, but a lot of people with this sort of prejudice in mind that mortgage insurance is a scam, and I've always told I should avoid that, they wouldn't think of buying a house with less than 20% down because they don't want to pay mortgage insurance, not realizing that it's really quite modest and it might get you into something much sooner and a much better situation. Now, if you take this 680 credit score person, you take them to down from 15% down to 3% down, well, you see here the mortgage insurance is actually quite high. And that's where you see the impact of credit score felt the most. Where if you're putting low money down and you have a fair to middling credit score or a poor credit score, you're going to pay quite a high amount in mortgage insurance costs. So you see here, this same deal that was $78 a month with a 680 credit score with 15% down is going to be $396 a month with 3% down. So that's quite a big factor. Now I also want to consider just the impact of a credit score change at the same level of down payment. So let's say you have 15% down. If you have a 680 credit score, as we just said, as we just saw, you're paying $78 a month. If you have a 740 credit score, you're going to pay $39 a month. Now, a couple of things to note here. This is exactly half in this case, from going from 680 to 740, but also note that it's in both cases, it's pretty inconsequential. So if you have a fair amount down, having a not so great credit score isn't really that consequential, because you can see the monthly cost differential between having a great credit score of 740 and having a relatively poor or middle-end credit score of 680 is only $39 a month all in on your mortgage payment. So pretty inconsequential. However, again, if you go to this 3% down threshold, now a 680 credit score, you're at $396, but if you have a 740 credit score, that's $205 a month. So that's $191 a month less for having a better credit score. So much more consequential when you get into these low down payment ranges. But it's also a reason why I will advise people, you can even have if you have good credit, you can even have a relatively small amount or even very small down payment amount, and it's not a huge impact on your overall monthly payment. And the one thing I want to remind you is don't forget this element in your shopping. Don't forget to consider mortgage insurance. A lot of times people will shop with different lenders and they will only pay attention to the rate. And sometimes that's intentional. The lender will only talk to you about the rate. And even unintentional, maybe just subconsciously, it's not as big a factor. You don't talk about it as much. It's not something that's shopped as much. But different lenders will have different mortgage insurance rates. And so you may go one place where the rate's lower, but the mortgage insurance cost is higher. And it could be significantly higher. So pay attention to that. Now understand you're still going to give more weight to the interest rate because that's a permanent element. The interest rate doesn't go away until you pay off that loan, whereas mortgage insurance might go away before you pay off that loan. So it's not to be weighted as heavily as the interest rate is, but don't ignore it altogether. Do compare that mortgage insurance factor along with the interest rate. Look at the overall payment when you're shopping. Now let's talk a little bit about how to remove mortgage insurance. There are two different categories in this. One is your statutorily protected right to do so, and the other is the lender discretion way of removing mortgage insurance. The statutorily protected right, the difference between them is that if you, under the statutorily protected right to remove mortgage insurance, you can only rely on the lower of the original purchase price or the current value of the property. So you can't use market appreciation. A lot of people will get into a home, have less than 20% down, have mortgage insurance, and then the market will bolster them, especially in the last couple of years in this market, and get them over that 20% threshold. Well, you don't have a statutorily protected right to have mortgage insurance removed based upon market appreciation. Now, many lenders will do that at their discretion, and we'll talk about that in a second. But let's talk first about your statutorily protected right. When you get mortgage insurance, you'll get a disclosure, and it's just called a mortgage insurance disclosure. Let's see what it's called here. It's called Private Mortgage Insurance Disclosure, Fixed Rate Mortgage. And in that disclosure, you will see what those rights are. And basically, your two ways of doing that are either you can either request it or it can be automatically removed. So you can request mortgage insurance removal when your loan to value is scheduled to reach 80% of the original value of the home. And when I say scheduled, I mean based upon the original amortization schedule. Here's your payments over the next 30 years. Here's what the balance is going to be on your mortgage after you make these payments. And it's only what's scheduled over that period. The point at which your mortgage is scheduled to reach 80%, that's the point in which you can request to have mortgage insurance removed. Or you can also request it to be removed when it actually reaches 80% of the original value only. And that would be the situation where you make extra payments. Let's say you get a bonus, you get a gift from family members, or you're just throwing some extra money out over time. And so your threshold, your principal balance is going down faster than what it was originally scheduled to based upon the terms of the mortgage. And when it actually reaches 80% of the value, you can also request to have it removed. And these don't have any kind of a seasoning threshold. You don't have to be in a mortgage for any particular point in time. Of course, typically when you are scheduled to reach 80%, it's going to be more than 2 years out. But when you actually reach 80%, that could be a very short time after you get into the mortgage, depending on when you come into those extra funds to pay that down or what the original value of the mortgage was. And so that's when it can be requested. There's a point at which it's automatically removed, and that's when it's scheduled to reach 78% of the original value or the lower of the original value or current market value. And when I say lower of, a lender can, if you go into a period of general property decline, they can ask you to demonstrate that that value hasn't declined below the original purchase price. And if it has, they can decline to remove that mortgage insurance. Now, a couple of caveats here with regard to requesting mortgage insurance removal. If you're requesting it to be removed, as opposed to if you have it automatically removed, it will automatically happen unless you're delinquent at the time that that automatic renewal threshold happens. If you're delinquent at that time, it won't automatically remove. It will only automatically remove when you become current again on that mortgage. But if you request it, you actually have a 24-month look-back period. And if the last 12 months you have a 30-day late, then they don't have to honor that request. And if in the last 24 months you have a 60-day late on that mortgage, they don't have to honor that request. So just keep that in mind. You do have to be current in all situations. And you do have to have a clean history basically in the last 24 months if you're requesting it versus an automatic. Now let's talk about one more thing, and this is when you're using market appreciation. And this is far more common for a lot of people in these appreciating markets that we've seen. If you're requesting removal based upon market appreciation, most lenders, it's very common of them to require a 2-year seasoning before they'll grant that. They'll require you to be in that property for 2 years. And then typically you will have to bring an appraisal or some other valuation method to bear that they respect. That will demonstrate to them that, look, my value is there, I have more than enough equity, I'd like for you to remove this mortgage insurance. And that's generally granted that I've seen. Now, I don't have any mass amounts of data on this, but in all the circumstances where my clients have sought that out, and every one that I'm aware of that's been granted, it could take a couple of months before that happens. But the lender really has no incentive to keep you in that mortgage insurance when the value is already there, because they're not earning the income on that mortgage insurance. And so they don't mind letting you release that. So that's about it for now for mortgage insurance. If this has been helpful to you, please subscribe, like, share this with others. I cover a lot of different topics regarding mortgage in this Mortgage Mastery Theater channel, and love it if you subscribe and come back later. Thanks so much.